This week in economics on the 25th of December 2016. Numbers man here. We're coming to you on WBRN radio in Boston and over the Bostonred Network. Take this opportunity to wish everyone a happy holidays, a happy Christmas, a happy Hanukkah, and starting on the 26th, happy Kwanzaa. Don't leave anyone out there. There are various other holidays perhaps we missed. But nonetheless, let's get right to it. Here, incidentally, we've opened back up on the Blog Talk outlet. We were out of there for several weeks. We understand that we had to redo our volume there. We had 300 and something programs on that particular channel alone, so we had to redo those things. But nonetheless, let's get to the latest figures here. These were out on the 22nd, which is on Thursday. Thursday national income and product accounts for the third quarter, Q3, and this is the third revision there, and also corporate profits. Let's get to it. The real domestic product increased at an annual rate of 3.5% in Q3 of 2016. According to the third estimate released, the second estimate in the second quarter, real GNP grew 1.4%. This particular estimate is based upon more complete big data. In the second estimate, the increase in real GDP was 3.2%, with the third estimate for the third quarter, non-residential fixed personal investment, local government investment, etc. Here we'll start looking at some of this. The real gross domestic income, that's GDI, increased 4.8% in Q3 compared with an increase of 0.7% in Q2. The average GDP and real GDI, a supplemental measure of the U.S. economic activity that equally weighs GDP and GDI, increased 4.1% in Q3 compared with an increase of 1.1% in Q2. The increase in real GDP and the third quarter primarily reflects positive contributions from PCE, exports, private investment, non-residential fixed investment, federal government spending that were partially offset by negative contributions from residential fixed investments, imports, which are subtracted in the calculation of GDP. The acceleration in GDP in Q3 primarily reflects an upturn in private inventory investment, acceleration in exports, a small decrease in state and local government spending, which is normal as you go into Q3. An upturn in federal government spending, small decrease in residential investment. The current dollar GDP increased 5%, or $225.2 billion in Q3, a level of $18,675.3 billion. In Q2, the current dollar GDP increased 3.7%, or $168.5 billion. There, the price index for gross domestic purchases increased 1.5% in Q3 compared with an increase of 2.1% in Q2. The PCE price index increased 1.5% compared with 2% in Q2. Excluding food and energy, the PCE index increased 1.7% compared with an increase of 1.8% in Q2. Update to GDP. The upward revision to the percentage change in real GDP reflects revisions to non-residential fixed investment, PCE, local government spending. There's what they cite. And if we look at the advanced and third estimates, real GDP in the advanced estimate was at 2.9, in the second estimate at 3.2, and as more data arrived, 3.5. Real GDI, let me get the current dollar GDP at in the advanced at 4.4, in the second estimate at 4.6, and at 5% in the third estimate. Real GDI in the second estimate at 5.2 and 4.8 in the third. Actually went down a bit. Real GDP and real GDI in the second estimate 4.2, 4.1 in the third estimate. Gross domestic purchases index in the advanced estimate, it was at 1.6, then 1.5 in the second, and it's still 1.5. Corporate profits with inventory variation and adjustments increased 117.8 billion in Q3, in contrast to a decrease of 12.5 billion in Q2. Profits of domestic financial corporations increased 50.1 billion in Q3, compared with an increase of 5.6 billion in Q2. Profits of domestic non-financial corporations increased 66.4 billion, in contrast to a decrease of 56.1 billion. That would have been in Q2. The rest of the world component profit increased at 1.3 billion, compared with an increase of 38 billion. This measure is calculated as the difference between receipts from the rest of the world and payments to the rest of the world. In Q3, receipts decreased by 1.3 billion and payments decreased by 2.6 billion. And this is the next schedule. For 2016 Q4, we'll have the on January 27th. That'll be for the annual, and the Q4 will be released there. That will be the advance, and the third release will be on March the 30th. Corporate profits also on March the 30th, and Q1 will be on the 28th of April. That will be the advanced, and the third estimate, the more accurate one, will be on June 29th. So we're getting a little bit ahead of ourselves here. And so now let's go to state personal income. Interesting to look at some of these. State personal income growth decelerated to 1.1% on the average in Q3 of 2016. From 1.2% in the second quarter, according to estimates released today by the Bureau of Economic Analysis. Personal income grew in every state in Q2, with growth rates ranging from 0.4 in Oklahoma to 1.4% in South Dakota. So South Dakota was at the top. Earnings increased 1.3% in Q3 of 2016, was a leading contribution to growth in personal income in most states. And as we're looking at it here, in South Dakota, this is a percentage change from 2 to 3, 1.8%, and Oregon 1.7%, Minnesota 1.6%, Massachusetts 1.5%, Pennsylvania 1.4%. That's good for Pennsylvania. And West Virginia at 0.8%, New Mexico at 0.7%, Montana at 0.5% there, and Wyoming at 4%, and bottoming out Oklahoma at 0.3% there. So the fastest growing states, according to this bellwether, were Pennsylvania, Minnesota, Massachusetts, and Oregon, where personal income grew 1.4% 3%. Pennsylvania's growth in healthcare and social assistant earnings and in professional, scientific, technical service earnings were the leading contribution to the 1.4%. In Minnesota, growth in healthcare, social assistance earnings, in finance, insurance earnings were the leading contributors to the 1.6% in total growth. In the Commonwealth of Massachusetts, growth in professional, scientific, technical service earnings, in finance, insurance earnings were the leading contribution there to 1.5. In Oregon, growth in state and local government earnings, professional, scientific, technical services earnings were the leading contributors to the 1.7%. For the nation, earnings grew in 22 of 24 industries that the Bureau of Economic Analysis looks at there. And if we healthcare, social assistance, etc. Mining earnings fell 1.4% nationally in the third quarter, the 8th consecutive quarterly decline. Lower mining earnings contributed to below average earnings and personal income growth. In the five slowest growing states, Montana, New Mexico, West Virginia, Wyoming, and Oklahoma. In Montana, the leading contributor to slower income growth was, that's interesting, healthcare and social assistance industry, where earnings declined in the third quarter after bonuses were paid in the second quarter. In West Virginia and Oklahoma, declines in state and local government earnings were the leading contributors to slow income growth. When you look at those two states, West Virginia and Oklahoma, not very much going on there. State and local governments are in a pinch because they simply do not have the tax revenues. Now, the one that's a little bit strange is Montana. Income growth was in the healthcare and social assistance industry there, and anyway, nonetheless, the BA also releases revised quarterly personal estimates for Q1 to Q2. We won't go into those, but this does give a picture of what states are moving forward and what states basically are not doing as well as one would think. And if we look across the map here, color map, we throw in Arkansas and West Virginia into that, and then you have states like Texas. That's kind of in the intermediate channel there, and states like California, for instance. Let's see, looking at the color code, 1%, but it's 1.2%. California was not even mentioned in this. In fact, we'll put this graphic up. It's color-coded. The lighter colors are the states that had less growth in personal income, and the next color is a sort of a light beige or brown, or what do you want to call it, and then a beige and a darker beige at 1.1 to 1.2. And the darkest colors are the states that had the top amount of growth. So we'll look at those, and we'll tell right away where we stand in those growth tables. We'll next look at the Russell 2000, the small cap stocks, and see where those are. Let me just get the small cap market index of the bottom 2,000 in of the Russell 3,000. We don't do the Russell 3,000, but the 2,000 is the most common benchmark for mutual funds that identify themselves as small caps. Well, the S&P 500 years talk about that. Those are the larger caps. The market cap of the largest companies in the index is around $5 billion. It first trades above 1,000 level in 2013. Small caps include the S&P 600 from the Standard & Poor's people there. And it closed on a Friday at 1,388.7. And some years of return here, just to give you an example. In 1999, the rate of return was 19.62. In 2000, it was negative 4.2. And in 2007, it was negative 2.75. And in the Depression, it was negative 34.8. In 2008, 2009, it rebounded under President Obama at 25.22. And in 2010, had a good year also at 25.31. In 2014, it was 3.53%. And in 2015, it was a negative year, 5.250 percentage there. So some of what was going on with the Russell 2000. But we'll go to Reuters now, and how various stock funds could suffer under DJ Trump. And this is by Mr. Campus, writing for Reuters here. The year-end stock rally on the heels of DJ Trump's election was built on expectation of reduced regulation, big tax cuts, and a large stimulus, fiscal stimulus. New signs emerging that the Trump camp that the harsher trading policies could jeopardize the honeymoon are likely in the offing. Investors could be well advised to give those prospects more weight when gauging how much for the already pricey market. The market is pricey at this point in time. The China hawk will be in the mix at the National Trade Council. Peter Navarro, he's a critic of China. If implemented, economists at Deutsche Bank estimate the tax cut could send inflation far above the Fed's. And this is one of the problems that you always have, 2% target, and drive a 15% surge in the dollar. Analysts calculate that all else being equal, a 5% increase in the dollar translates to about 3% negative earnings revision for the S&P 500. A half-point drag on domestic gross domestic product. The dollar index has already gained more than that's the DYX index, more than 5% since the election. Harsher trade policies may not cause a full slowdown. Well, that is a debatable situation. We looked at that initially, perhaps not. And this is from, let me see, who is it there? Brian Jenkinson at the, he's a chief portfolio strategist at Wells Fargo Fund Management in Menominee Falls, Wisconsin. But I don't expect to a localized recession in manufacturing and small gains in, gains in manufacturing employment as well. Well, manufacturing is not what it used to be, so it shouldn't be confused with the large manufacturing enterprises of the 70s and some into the 80s. Now they're very smaller enterprises, much more evenly spread out, many of them, between what is done stateside and what is done in other emerging quote-unquote markets. He said the broader tax could trigger retaliation, pouring uncertainty in the market. You will have some uncertainty, and the markets, however, these days move much faster than in the past. Stocks have rallied broadly since the 8th, with the S&P advancing 5.7%, and the DJI surging 9% to brush up against the 2,000 mark. I remember when we had the 1,000 mark. Anyway, go back a long time. Since some sectors such as banking have shot up 25% in the post-election. Now, when you try talking about the banking sector, bank stocks, there is one thing, and the financial worth of all the banks are a separate issue. U.S. equities have gotten substantially pricier from valuation vantage as well. Forward pricing to earnings ratio in the S&P 500 has risen a full point since election day, from 16.6 to 17.6. That's Thomson Reuters data there. The markets, that makes the market about 17% more expensive relative to their earnings potential than their long-term average multiples, around 15%. Small caps have gotten pricier still. The forward multiple, and this is, we just went over, the Russell 2000 has risen to 26 from 22. That was on the 8th of November, up 18%, while the index price has climbed 14%. S&P 500 earnings are expected to rise 12.5% next year. That's according to Thomson Reuters research. Anything that impedes companies from achieving that target, such as a bump in a trade spat or further dollar depreciation in anticipation of new trade barriers, could undermine the equation. Well, you will have some of that. The economy is not static, it's dynamic. The latest poll, this is from Thomson Reuters, primary dealers and economists at Wall Street's top banks cites Trump's evolving trade policy over other factors such as fiscal policy, a strong dollar, higher interest rates as the greatest risk to near-term economic outlook. Well, the problem with trade policy is that trade policy is speculative. To implement the types of tariffs that he is proposing, we first have to see that. Now, this is not to discount the initial reaction, because much on the market is not based upon factual information, but speculation, exuberance. So if you start to get an exuberance that they're going to start a trade war with China, and China would have to take positive effects, and they've already been doing some of this, moving more to their domestic economy. They could also decide that they are going to send, which would be a very wise move on their part, less product to the U.S. And as that percentage is decreased, then you have companies like Apple would be forced to find another supplier. And also with the suppliers they have, the product would become much more expensive. Thus the tablets and iPhones would become more expensive, and the stock of Apple would go down as their revenue go down. So these are not unintended effects, and we've emphasized that these are effects that we already knew about. Now, some other type of problem, because the problem in the U.S. economy, you have to look at it as many little economies put together. For instance, when energy prices or energy product goes up, primarily petrol prices, that takes billions of dollars out of the economy, discretionary consumer dollars, and thus 70% of the economy starts to suffer. So you start looking at retailers, etc. That's back to some of these small stocks. And Carla Icahn put an argument forth on some of the ET funds out there, the way that they are operated on the long and short, and that gets a little bit more complicated, who is betting on whom, but they're not as solid as one would think. Now, Icahn himself is an active investor versus a passive investor. It's a little bit different kind of situation. But the wise old owls like Icon can short a certain stock or even a sector and reap enormous profits from it, whereas the other people start to take a bath and panic. So when you are dealing with this type of situation, it is different from what you would normally look at. So here we not only look at GDP and the basics, but we also look at the markets where they are at any given time. Because outside of the Fed, one of the biggest influences obviously is the markets and where the markets are perceived to be. But in what is a more and more internationalized economy, you really just cannot look at it as old factors there. The Chinese electric car battery industry is evidently starting up. This is another headline from Reuters. This is again a global market here. This is in a third tier Chinese city in the southeast. Nidin. So China is a top bottom in industry policy, moving up the value chain. Cleaning up polluted urban skies and shifting to plug-in cars. A very good solution there. The answer to Japan's Panasonic and South Korea's LG Chang Limited, LG as they're called, have tripled its production capacity for lithium-ion car batteries, ready in the past year to keep up with the surge in China sales of electric cars. Very important. After a second major funding complete in October, the company quadrupled to 80 billion yuan. That's $11.5 billion there. And it's already overtaken LG Chang in lithium car battery output and is chasing down a Panasonic. And Warren Buffett's back BYD Company Limited. So this is one of they plan to grow their battery capacity sixfold by 2020 to 50 gigawatt hours when it put headed of Tesla's Inc. Gigafactory in Nevada. So in other words, these companies are coming to the latest technology. As we see it, will have more impact on what is going on in the world than some of the other old school machinations, we'll call it. The company was founded 5 years ago and is already pushing beyond the borders of China, in Sweden, in Germany, and in France, and plans to build a factory in Europe. The company's representatives say, but well, anyway, they can't talk about it, for BMW. Building it to become a Chinese champion, a battery maker first must shed any foreign investment to be eligible for subsidies and other policy support. Initially had about a 25, who are they? A Pextrol Technologies, a company now majority owned by Japan's TDK. So there's a lot of people own a lot of different companies here, but they're moving in the right direction. Mr. Zen, he is a doctorate in chemistry that is running the situation. Government support for electric cars, demand for components such as batteries. Beijing is also rolling out other policies that could benefit leading producers like cattle. by forming small companies to by forcing small companies to consolidate or go out of business. The Ministry of Industry and Technology last month is considering a rule that would increase minimum product requirements for battery makers by 40 times to 80 gigawatt hours. Subsidy support for batteries is a fairly modest compared to those for producing electric vehicles. A total of 4.5 billion. Not a lot of money when you get into a high stakes game. Among national 2020 targets to behave battery costs to below 1 yen. That is 0.144 per kilowatt hours. So they're working on their R&D, which they should be working on. China has been advancing in R&D, and in the U.S. and some of the old hat nations, you don't hear very much about R&D. You hear things about other quote-unquote problems and trade wars and all of that. To paraphrase DJ Trump, they should spend more time on R&D. He didn't say that. He was referring to a trade union that should be working harder. Well, part of the problem is that a lot of the U.S. market time is actually spent doing other things. So we have to look at that. We'll go now to the BBC as we round things out here and do the numbers. We use the BBC to do our numbers and to get more of a global look at how things are occurring. And let's quickly move to the BBC economic growth revised up 0.6. This is on the 23rd here. This is their Q3 GDP is revised up from the Office of National Statistics. This is growth from July to September period. Had originally been estimated at 0.5%. The Office of National Statistics trimmed its estimate growth in the first and second quarter of the year. It now says the economy grew at 0.3 in the first quarter, compared with an earlier figure of 0.4. Cut its estimate for the second quarter to 0.6. And from Ruth Gregory, she is the UK economist at Capital Economics, says that the figure suggests that the June Brexit vote had little impact on the economy, that growth in the final quarter of the year would be positive. Well, it will be positive, but the latest set of national accounts leaves the economy looking even stronger after the referendum than previously estimated. That's according to that economist. GDP growth in Q3 was revised up from 0.5% to 0.6%, and 0.7% growth rate seen in the second quarter was revised down to 6. We already went over that. Figures from the National Office of Statistics show that the UK's service sector, which accounts for 80% in their economy, 70% of the U.S. economy, grew by 0.3 in October from the month before. According to a statistician here, Darren Morgan, robust consumer demand continues to help the UK economy grow steadily in the third quarter of 2016. Growth was slightly stronger than thought, though due to greater output in the financial sector. New figures on service also suggest that growth in the predominant sector of the economy continued in October, helped in part by another strong showing from retailers. From Martin Beck, a senior economist, economic advisor. said the figure has brought some unexpected pre-Christmas cheer. However, he added that there's a still question mark as to how long consumer spending can continue to drive the economy. With high inflation setting to weigh in further on the spending power next year, the consumer is already set to flutter soon. Separate figures show the UK current account deficit widened towards record levels in Q3 with few signs in the fall in the pound in wake of the Brexit vote has helped to boost exports. The widened gap for the period, 25.49 billion pounds for a deficit of 22.79 billion pounds in the second quarter, while the lower than economists had expected, it caused the deficit to rise to 5.2% of GNP from 4.6% of GDP. The record percentage level was 6% in 2013. So this will be on our Twitter feed, and we'll also put it up at on our Facebook page at Cranston Analytics. We'll get all these things up there as we move along here. Let me see what we've got here. Yeah, we'll take a quick look at government borrowing while we are here. This is in the UK. Government borrowing fell less than expected in November. However, the fall was less than analysts had been expected. Government borrowing fell to 12.6 billion pounds, down from 0.6 billion for November 2015. The figure had been expected to shrink to 11.6 billion pounds. That's according to a panel of economists. Borrowing for the financial year so far is down over last year from April to November. Borrowing, excluding state-owned banks, fell by 7.7 billion pounds to 59.5 billion pounds. Despite smaller than expected falls in November borrowing figures, economists say the government's on track to meet less ambitious deficit forecasts set out in the November autumn statement. The Chancellor Hammond said at the time the government was aiming for a higher budget deficit of 68.2 billion pounds for the full financial year, well above the predecessor of George Osborne. He had 55.5 billion target there. The public finances last time around, October, were unexpectedly healthy, with the government having to borrow less than expected in November, but went into reverse. This is from Andrew Verdi. He's an economist at the BBC. It is traditionally a tough month for the Exchequer, that's their treasury, with more money flowing out than flowing in, but the government, more accurately the public sector, overspent its income by more than expected and therefore had to borrow the 12.6 billion. If your Yuletide glass is half full and is still broadly in line with projections at the last autumn statement that the government would borrow, 68 billion pounds over the full financial year to end in April. While the government spending is growing, tax receipts from VAT income are growing faster too. They have VAT there. Is their national sales tax. and we won't continue on with this, but we'll run back very quickly here as we catch Deutsche Bank agreed to pay a 7.2 billion penalty to in the U.S. to settle irregularities in investigation mortgage-backed securities. Still on that, the the sum which needs a final approval is far lower than the 14 billion the U.S. government has asked. That's about half. The looming fine could cause concern that the failure of a bank could pose risks to the global financial system. Credit Suisse also announced a similar deal, while Barclays is under investigation too. So in other words, all these banks participate. The sale of residential mortgage-backed securities played a major role in the depression of 2008, or they call it a fiscal crisis of the Great Recession, or whatever. Nonetheless, Credit Suisse has said it has agreed to a $5.28 billion deal to settle its own dispute with the U.S. authorities. The Swiss bank will pay U.S. authorities $2.48 billion and will also give consumers $2.8 billion in compensation over the next 5 years. The Department of Justice is also suing Barclays Bank, and Deutsche Bank would be happy if the settlement, it will be painful, but not necessarily as painful as it could be. No doubt about that. They're getting away at about 50% below. Deutsche Bank was expected to pay in the region of $5 billion. The Department of Justice asked for $14 billion. Similar story from Credit Suisse. A penalty there, overall penalty of $5.3 billion, of which $2 billion goes towards helping borrowers. Should be more than that. Deutsche Bank, which operates in 70 countries, has 100,000 workers, but is shedding 15% of the workforce in its retail banking sector, post-bank, and pulling out of other countries. On the settlement, Deutsche Bank would be made up of a civil penalty of $3.1 billion, as well as $4.1 billion in consumer relief there. Goldman Sachs, it's a long list of these characters, had settled, let's see what Goldman did. Other banks here. Citibank, $12 billion penalty there, reduced to $7 billion. J.P. Morgan Chase was fined $13 billion. Bank of America paid $16 billion, and now we find that Goldman Sachs, they paid $5.1 billion there. So, in other words, all of these banks are now paying. It could have been worse for Deutsche Bank, but the punishment that has been agreed with the Department of Justice will put a heavy burden on the country's biggest financial institutions for years to come. That is from Klaus Halbersmith, There, so in other words, yes, it is and Tobias Kaiser said that the deal would generate a sign of relief at Deutsche Bank's headquarters, but the punishment that now has been agreed upon is still a hefty one. He was writing in the Das Wisch, the German publication. Anyway, so much for that. Let's go and do the numbers. And see exactly where the markets are. This was the Global 30 was down 0.31%, 0.31 actually. The FTSE, all shares, on Friday, 2.59. In Amsterdam, they were at 0.39 on Friday. In Frankfurt, the DAC was down 6.71. In Paris, 5.05, or not 5. In Brussels, 2.87. In Madrid, 34.10, all on Friday. In Zurich, they were down 5.34. In Moscow, on Friday, they were down 1.46. In Johannesburg, they were also down on Friday, 294.82. In Bombay, on Monday, they were down 206.39. In Karachi on Sunday, they were down 65.79. In Lahore on Friday, they were down 45.11. In Colombo on Friday, 6.91. In Tehran on Sunday, they were down 262.03. In Sydney on Thursday, they were down 16.70. The Nikkei on Sunday, down 4.15. The Hang Seng in Hong Kong on Friday was down 61.44. In Shanghai on Friday, they were down 29.40. The Dow on Friday was was up 14.93. The Nasdaq was also up 15.27. The Merc, that's the commodities exchange out in the Midwest city of Chicago, 2.83. In San Pablo on Monday, 1,046.17 in the negative. And finally in Mexico on Friday, 165.46. And the commodities, the other gauge that we look at, it's interesting. In a modern industrial economy, commodities play a very, very large or have a very large influence. This is on Friday. The Brent crude futures were up 3 cents at $55.08. The spot was at $55.10. It was up also 13 cents. West Texas Intermediate on Friday at $52.98. It was also up 3 cents. Cocoa futures were up $75. Coffee futures, C futures, were down $2.95. Okay, getting carried away here. On Friday, the Forex Gold futures up 45 cents at $1,131. Dubai Gold futures, an ounce there, were up $2.60 at $1,133 even, and silver was down 3 cents at $15.74. On to the Euronext Life futures. Cocoa was up $10 on Friday. Robusta coffee was up $20. The Bloomberg Commodities Index, which we use here, was down 4 cents at 86.29. So that's a negative 0.1% for the commodities index. So commodities were down a little bit. But the most important one, oil is finally back. Petrol is back to the $50 break-even price. It's at $55, $52. So as it continues to go up, consumer discretionary income will go down. So we will be watching those developments. We have one more program for the year 2016. It'll be next week. And somewhere in between, we'll have a year-end cap in financial news as we get ready for the transition from the Obama administration and their economic policies to a Trump regime and the economic policies that have been in the news, but there's one thing to announce a policy. Then, of course, you have to implement it. And in some cases, the congressional action has to take place. And then it's the reaction when the policy is implemented. But that may or may not be, as you saw in the basics, that will be the final reaction. Markets tend to, these days, get accustomed to changes, but they're sort of hidden things in the system. In terms of basics, more of a long-term effect, not a short-term effect. So many times what can happen is there can be some pinned-up exuberance there for people that supported the breakup in the UK economy, consumers primarily. But will that last? They are running the higher deficits. The UK economy is not what I would call stellar. None of the European economies are. They're all making adjustments. So we'll look at this, and we'll also look at the Trump showdown with China, how that affects China, but also more broadly how it affects U.S. corporations that have to deal with China. Because what China is doing was illustrated with the lithium-ion car batteries. They're moving up the chain and moving up the chain quickly. So they're starting to manufacture more and more items that are essential for their economy and the world economy. So the lithium-ion batteries, the battery life is getting better. Their batteries will get better. They'll be able to take on a Tesla. And a lot of that will depend on which technologies they are using, and the technologies will become more on par. Then it becomes down to cost, how they can produce that as they get their quality control and their R&D. What has happened in this country, a lot of R&D has disappeared. And under a Trump regime, we don't see an emphasis on R&D. What we do see is moving to the old hat industries, i.e. the fossil industries there. Of course, the infrastructure, that's something that just tops everything off and will carry you for a day. But still, you're dealing with steel and various products that go into infrastructure. Now, the actual infrastructure, it depends on what you're building. If you're building highways or if you're building airports, you're talking about usually about anywhere from 2 to 4 years of building. It really depends these days because a lot of prefabbing out there. But if you're building a for instance, if you were building a new airport for the New York, Jersey area, that is more of a long-term type of project that should be done. Not saying they're going to build it, but if they're just building highways out in Montana or someplace, that's a totally different. Although that type of building itself is more and more mechanized today. People are not shoveling by hand; they are shoveling by machine, and eventually by not only machines but computer assistants or robotic machines. You'll start to see more in these enter the construction phase, and as that happens, some of the more dangerous jobs, as in the automobile industry, will start to disappear in steel, etc. Robots will take that over. So you will see less and less quote-unquote human intervention out there, and we're going to devote a special program to that either next week or the next week, probably next week, because we have a little time off from some of the work and from university. Nonetheless, happy holidays to everyone. We'll talk to you next week, and unless we have some special programming here, there's a few things we are working on, and one's the effects of robotics. That is one. We'll also be looking at taxation, and a few other little pet peeves we have on the old research bin. Good day.